Hi guys, welcome to this Moneycontrol live stream. I am Nandita Khemka. Well, the Indian economy is on a strong footing in the wake of robust economic data, and global agencies also believe that we will retain the tag of the fastest growing economy. Now, we had blowout GDP growth figures for FY24. The recent inflation data shows that headline CPI is at a 12-month low, and factory output data has also been quite strong. But we've just had an election outcome that was contrary to expectations. So how will reforms really shape up as the coalition era returns? Well, to talk about that and a lot more, we're now joined by Upasana Chachra, who's the Chief India Economist at Morgan Stanley, and she joins us on the sidelines of the Morgan Stanley India Investment Forum. Great to have you on the show, Upasana. You know, as I was mentioning, we've had an election outcome that wasn't really as per expectations. But the dust seems to have settled as Modi 3.0 is indicating policy continuity. But how are you really perceiving the return of coalition era and its impact on the economy?
Sure, Nandita. So we have seen the election outcome. It's almost, I think, well digested by now, and we are seeing evidence of policy continuity and stable government. So when we think about our forecasts and macro outlook, we were in our base case assuming a stable government and policy continuity. I think barring the election day volatility and concerns, I think as we see the dust settled, what we are getting is similar to what we are assuming in our base case, which is a stable government and policy continuity. So I think, there's a bit of a surprise, but at the end of the day, in terms of final outcomes, we don't really see any material change in the functioning of the government or the stability of the government. So we, maintain our constructive view on both the near term and the medium term outlook for India.
Right, but do you think now that the focus will shift towards reviving consumption that has lagged thus far? And would you expect the government to still tilt more towards populist measures and prioritize the alleviation of rural stress rather than powering ahead with the manufacturing-led reforms at the same pace?
So in our view, the playbook for the government is not going to change versus what we saw in the previous term. So we do think that the focus will continue to be on capex and job creation, because in our view, those are more sustainable ways of creating growth and creating a virtuous cycle of growth in the economy, especially given the vast surplus labor that India has. I think the paramount importance for the government would be to create high productive jobs, especially in the non-farm sector. So in that context, I think the overarching playbook or focus on capex, on manufacturing should not go away, and that's what we maintain. We think that the government will continue on that path, will continue to focus on capex, and we do know that the fiscal dynamics are better than what we had at the time of the interim budget in terms of the fiscal math. So that does provide some flexibility, but in our view, the focus on capex, fiscal prudence will continue, with probably better targeting on the redistributive side in terms of spending.
Right. In terms of the investment cycle, here on, do you expect private capex to take the lead? Because till now we've seen government capex really driving the investment cycle.
So I think, the economy is about 2 years plus into the expansion cycle. If we see that March 22 was when the pandemic-led disruptions were and restrictions were finally lifted, and it's in the initial years of the cycle. Yes, the investment rate has been supported by public capital spending, and probably rightly so. From here on, our view is that private capex and private capital spending will pick up. There are some nascent signs of that recovery already. And I think as we go further into this expansion cycle, with end demand holding up, capacity utilization rates picking up, and also clean balance sheets for both the corporates and the financial sector, I think all the ingredients are in place which will set the stage for capex to go higher in a more broad-based manner. So I think there will be more evident signs of capital spending by private corporates picking up in the second half of the fiscal year. We had that view and we maintain that view. I think public capital spending also remains robust, but yes, the delta should come more from the private corporate side now.
Let's also talk about the growth figures that just came in, right? We've topped the 8% mark for FY24, but there's a sizable gap between GDP and GVA. How would you read into that?
Well, yes, that is one issue. The GVA numbers have been lower than GDP in the last few quarters, and therefore in the fiscal 24 numbers that we see, some part of is mathematical in terms of which the way it is calculated, that is net indirect taxes. Tax growth has been pretty good on the indirect taxes side, and subsidies by the government has been coming down YOY basis. So that is feeding into this gap or the wedge that's existing between GVA and GDP. I think that wedge will narrow as we go into fiscal 25. Subsidy as per the interim budget is likely to be lower further, but declining at a slower pace, and tax collection, yes, robust, but probably continuing at a similar pace. So you will see some wedge reduction, and I think therefore to get a sense of underlying economic activity, probably GVA gives a better indication as well. And notwithstanding that, GVA in itself has also been pretty robust when we look at the trend in the quarterly numbers. So I think underlying growth momentum is pretty robust as reflected by GVA or GDP or even high frequency data points.
So would you make any adjustments to your FY25 and FY26 growth forecast? Because we had World Bank, they had upped their FY25 GDP forecast. In fact, RBI itself has also upped their estimates from 7% to 7.2%. Have you guys also made some adjustments to your estimates for the next two fiscals?
So we had released our mid-year outlooks in middle of May, so that is before the GDP data came out. Our expectation is for GDP growth to be at 6.8% for fiscal 25 and 6.5% for fiscal 26. We maintain those as of now, and for GVA growth we see the number at around 6.5%. I think that's a better number to focus at in terms of underlying growth momentum. And if you look at the March 24 GVA growth number, it was at 6.3%. So it's pretty much a case where we see steady trend in GVA growth. Probably the internals could change, but I think growth momentum remains pretty robust, reflected in the GVA numbers as well.
All right. So, what according to you could be the biggest risk now to the Indian economy, Upasana? Because inflation. Yesterday we had the monthly CPI data come in, and it's at a 12-month low. Core inflation has eased, but food inflation remains sticky, right? So, do you think that could emerge as a risk, or globally, is there any factor that could pose a big risk to the Indian economy?
See, from a cyclical perspective, some of the risk factors are more global than domestic in our view. The risks could stem from, sharp increases in global commodity prices or weather-related events, as you mentioned as well, rightly so, that food inflation remains sticky. So I think those are risks, but the strength of the macro stability indicators has also improved vastly in the last few years, and therefore the vulnerability to some of these risk parameters has reduced for India. So cyclically I would still say that these are risks. We would need to track food inflation, we need to track how the rainfall season pans out, how the crop sowing is, where global commodity prices settle, and also from a global growth perspective in terms of any downward surprises in global growth, especially US growth. Our base case does assume sort of steady global growth numbers. That's what our global team is assuming, and also no major slowdown in US per se, or a recession in US. So I think those are risks on the cyclical side. I think the other on the domestic side would definitely be to track the policy priorities for the government. So any change in the policy priorities and therefore what they mean from a macro stability outlook perspective will need to be tracked. Again, those still lie in the gamut of risks rather than base case, as we can expect no changes in the policy priorities.
Right, since we are talking about the global factors as well, what do you make of Fed Chairperson Jerome Powell's tone? We started the year with hopes of 6 rate cuts. We came down to 3, and now we are down to 1, as indicated by Powell himself. But he's also indicated that next year could see a more aggressive rate cut path. But how would you really, or when would you expect that one rate cut to come in? Would you say September is too early because you have the presidential elections in November? So are you looking at a November rate cut by the Fed, or would you say that it will happen right at the fag end of the year, somewhere around December?
So our US team's view remains of a September rate cut right now. They do think that data will pan out in a way that will give comfort to the US Fed, both on the growth and inflation side, which will allow them for a rate cut sometime in September. So September still remains the start for the rate cutting cycle. They do see, possibility of 3 rate cuts this year itself. So I think for now, that's what our US team view is. Of course, it is assuming that inflation would also be moderating and be more range bound, and also that growth is going to be showing some signs of slowdown on an incremental basis for the US economy.
All right, let's also talk about crude prices then. OPEC has given a strong demand forecast. It has also indicated that it will start increasing production from October. So in that light, right now we have crude prices hovering around the $82 per barrel mark. Where do you think crude is headed over the medium term? Would you expect it to be range bound between the $80 to perhaps $90 mark on the higher side?
Yes, our team's view is sort of similar. It is pretty range bound when we look at the near term forecast for the next 4 quarters odd. We don't really see we don't really have medium term growth crude oil forecasts as such, but in the next 3 to 4 quarters we do expect crude to remain pretty range bound. I think both demand and supply dynamics are panning out in a way which sort of keep crude in this range, as you mentioned, between 80 to 90. So similar views at our end as well.
Talking about some domestic factors now, we've already spoken about rural, end of the spectrum. But let's talk a little more in depth about that. For the first time in 5 quarters, FMCG rural volume growth had outpaced the urban volume growth. Do you think this trend will sustain, especially since there are forecasts of an above normal monsoon this year? Where are we in the consumption cycle according to you right now?
Yes, so in our view, the gap between rural-urban demand will narrow. As I mentioned, it's been about 2 years plus into the expansion cycle, and rural or low-income segments were hit harder by the pandemic, and after that as well, as the economy opened up, there were 2 other exogenous shocks in the form of higher inflation in 2022, and then the below-par monsoon that we experienced last year, which impacted agri output and therefore farm incomes. So I think in context of these shocks and therefore a weaker starting point as well due to the pandemic, rural demand has been on a weak footing. But we were expecting that as these shocks get more in the rear view mirror, and benefits of better job growth and the urban demand picking up trickles down, that will lead to a natural progression or natural improvement in the rural demand. I think that is what is getting reflected in the data when we talk about FMCG sales for rural volume growth doing better than urban in the March quarter. Similarly, we are also seeing some improvement in two-wheeler sales, especially relative to say PV sales. I think we do believe that this trend will continue, like there is this organic growth in rural demand which will happen because some of these disruptions are now getting behind us, and also the benefits of improved urban demand and labor income growth will pass through into the rural India as well, and of course supported by hopefully a better monsoon which as the season ends, and therefore farm incomes as well.
I want to also talk about the bond market, in some details. On counting day, we saw turbulence not just in the equity market, but even in the bond market, right? The 10-year yield shot past its 7% mark, and it hasn't really retreated since. What's your view on where the 10-year yield is headed from here, especially since we are bracing for a gush of foreign money to hit the Indian bond markets with the JP Morgan bond inclusion? Where do you see the 10-year bond yield heading from here?
I think from a bond market perspective, from a fundamental perspective, the demand supply is pretty nicely balanced for the bonds in terms of fiscal dynamics looking better, fiscal deficit for fiscal 24 being lower than expected, and we know the interim the RBI dividend going to be higher than what was put in the interim budget. As such, therefore, the demand supply is more favorable than probably where we were thinking in terms of estimates 6 months back, and also from the demand side, the bond index inclusion creating a new source of demand. So fundamentals, I think, are pretty supportive. I think in the near term, probably obviously the key event to watch will be the budget, and therefore till I think the budget event is not behind us, there could be some amount of nervousness in the bond markets, and therefore more range bound movement in the bond yields, I would say, more from a near term perspective. I think once the budget gives that clarity that the government continues to focus on fiscal prudence, there's more clarity on where issuances could be for this year, of course how they're going to use that fiscal headroom will come finally in the budget. I think that is where probably we'll see more definite trend in the bond yields, and therefore from a if we go by our assumptions, we think fiscal deficit could be 5.1 or could even be lower than that if they were to maintain fiscal prudence given the headroom, and then demand support from the bond index inclusion, then that bodes well for the bond yield perspective. But I think we need to wait and watch for the budget for a more definite trend here.
All right. Lastly, when do you really expect the rate cut cycle to start here in India? Because of course, many experts have pointed out that the Indian economy is in a Goldilocks situation right now, where the governor doesn't really need to take recourse to rate cuts. But in your view, would you expect at least one rate cut this year, or would you say that it could come in only by next year?
So we actually fall in the camp where we don't really expect a rate cut this year or even next year. In our view, that Goldilocks scenario that you just explained is what is impacting our framework as well. So with growth remaining so robust, we've discussed that previously as well, with upside surprises to GDP growth and upside upgrades to future GDP numbers as well, driven by capex and productivity. I think in that context, probably the neutral real rates for the economy would have moved higher. So we are working with that assumption that neutral real rates would have that the economy can absorb, without impacting the future outlook adversely, would have also moved higher. And therefore, with inflation numbers around 4.5% in our forecast horizon for fiscal 25 or fiscal 26, we don't really see the need for any major, or a scope for a rate cut, or the framework doesn't justify that. I think the key therefore would be to track, of course, inflation. One is that if inflation is sustainably at 4%, then that can open up the room. Or if we are wrong on our growth numbers, so growth numbers being lower than expected, probably also getting reflected in credit growth. Because I think the other aspect to this strong GDP growth is also that credit growth is pretty strong, and there's a gap between credit deposit growth reflected in pretty that credit deposit ratios are nearly at capacity levels. So with that setup that we currently have, it's very hard to create a framework for, I think, rate cuts at least anytime soon.
All right, then that's the view on when the first rate cut will kick in India. But with that, Upasana, I would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. Look forward to having another conversation with you sometime soon.
Thank you.
Well, with that, we've come to the end of this live stream. Thanks a lot for tuning in, but you guys stay tuned to Money Control for all your other news and updates.